Okay, so it's 4:02. We will begin. So welcome, good evening, ladies and gentlemen, to ASK India Select call as an initiative to reach more to the investors who've been doing this every quarter. Do follow us on YouTube. Our channel is ASK Investment Managers to get updates on all such sessions. So today's portfolio that we want to discuss is India Select. The India Select is now it's almost a 13-year-old portfolio with us, sorry, almost a 14-year-old portfolio with us, launched in 2010 January. The portfolio manages around 3,500 crores in AUM. The compounded returns for this fund look something like this. So 1 crore invested in 2010 is worth around 7.1 crores, and the benchmark in the same time has delivered around 4.7 crore to the 1 crore rupees. Okay, so the portfolio has a long-term track record and has compounded well for long-term investors. Managing the portfolio for us is Mr. Chetan Thacker. Chetan Thacker has been with ASK for close to 8.5 years now. His total experience is close to 14 years, 9 of which were spent in equity research. Mr. Thacker started with McKinsey as a research analyst and then went to work on for companies like HSBC Direct and MK Financials. And at ASK, he's been with us for around 8.5 years, like I said, and manages India Select amongst other portfolios. And I'm Sankalp Uppal, and I'll be the host for the evening. The format of today's call will be that Chetan Bhai will share his insights on the portfolio for the first 15 to 20 minutes, and then we will take questions live from the audience. And I have prepared a few from clients and clients and distributors. So that's the format. So please type in your question and we will take it towards the end of the call today. Over to you, Chetan Bhai, and welcome.
Yeah, thank you, Sankalpo. Good evening, everyone. Thanks a lot once again for joining us for this quarterly update call. So as Sankalpo highlighted, we'll probably cover in brief how the portfolio is structured at this point of time. What is our outlook on the market? How has the performance been in terms of the financial performance of the portfolio in the first quarter as well? And we leave you with how we see things going forward as well. So starting on the macro outlook, I think we've been highlighting for quite some time, and that continues to play out in this quarter as well. Domestic growth has been supported by CAPEX. CAPEX spend as evidenced by consumption, by growth in cement consumption and steel consumption remains strong. So it essentially points towards CAPEX intensity continuing to remain high. We've actually witnessed cement volumes increase by 9% YOY. In the first quarter, apparent steel consumption is up 10%. Hence, domestic growth is to a certain extent supported by what we are witnessing in terms of the CAPEX spend, especially as we approach the general election. And a lot of projects are scheduled for completion before we start the 2024 general election. On consumer staples, I think consumer demand continues to remain muted. This is the point that we've been highlighting for the 3 quarters, and that still continues. Volume growth continues to remain tepid. And the expectation here really going forward is that with monsoons, the way they have played out, increase in CAPEX spend, the expectation is that as we move forward into the festive season, you will essentially start to see an uptick. The backdrop of the global economy is that global economy continues to slow down. What we've witnessed is there has been destocking in the channel across various industries. What is adding to the pressure here is the fact that China anticipated a much better bounce back of their own domestic economy as they opened up and moved out of zero COVID. What has in turn played out is the bounce back there has been tepid, which in turn has meant that a lot of inventory which was piled on in China is now making its way to the world market, which is putting pressure on spreads, especially on commodity businesses. While on one side, it impacts the export growth for the country, and that has remained muted, especially in the first quarter. The issue started largely from Q4. The expectation is we'll see a lingering effect of this continue into Q2 as well. But on the flip side, you essentially have user industries which are users of these particular commodities. They continue to now witness a tailwind in terms of margin expansion because of reduction in commodity prices. So the expectation is that the margin tailwind will continue as we move forward into Q2 as well. And as we are set up for the festive season, which starts in Q3 this particular year, and that is where we expect you will witness both a combination of margins continuing to sustain higher. Coupled with that, we should essentially see volume uptake also happen. On the portfolio front, what has happened and the changes that we've made in the last couple of quarters, there are two key changes that you can witness. We continue to remain overweight on financials. We continue to remain overweight on consumption. Within consumption, it is more so consumption which is on the discretionary side and less on the staple side. While what we've added in the portfolio in this particular period is we've added weight in defense in this particular quarter. We've also added weight in oil and gas. So essentially, energy is something where the weight has gone up. It's more on the OMC side that we've added weight in the portfolio. And defense is one more name where we were highlighting for quite some time that we are on the lookout of names in this particular sector, and we've finally added a particular name in defense in the month of June. Just in continuation of the portfolio action, this is broadly the action. Bharat Electronics has been added to the portfolio, and Indian Oil is another name that has been added to the portfolio. While Aarti Industries was a name which has been exited. The reason is that while Aarti has witnessed a sharp uptick in the capex cycle, given what we are witnessing in the global markets, particularly, it started with dyes and textiles, it's gone on now to agrochemicals. So we expect earnings growth to remain lackluster in Aarti for some time before which they start to pick up. And hence we've exited Aarti Industries from the portfolio and replaced it with Bharat Electronics and Indian Oil. In terms of earnings growth, I think earnings growth, like we were highlighting, you essentially have a very benign base for the next two quarters, Q1 and Q2. So what we witnessed is we witnessed sharp operating profit growth in the first quarter for the portfolio. We've actually seen 33% growth in operating profit in the first quarter as compared to 22% growth for Nifty 50. If one has to adjust the impact of IOC, because all the OMCs had reported large losses last year, same quarter, primarily on account of marketing margins that were a loss. If we adjust for that, also what we witnessed is the India Select portfolio has essentially witnessed 25% operating profit growth in the first quarter, compared to a 14% growth in operating profit in the first quarter for the benchmark. What essentially stands out is also the revenue growth. So revenue growth for the portfolio has remained strong at 22%. This is on the backdrop of a situation where we are essentially witnessing tepid volume growth across various industries as far as domestic consumption is concerned, coupled with pressure on the exports as well. So despite that, we've essentially witnessed 22% revenue growth for the India Select portfolio. And a PAT growth of 33% adjusted for IOC's exposure, and for a similar number for the benchmark adjusting for OMCs is 19%. As we look ahead for FY24, our expectation is that we will witness 20-21% kind of operating profit growth in FY24, and we will essentially see a similar operating profit growth play out in FY25. While FY24 is essentially a story about first half being driven largely by margin expansion, the earnings growth that we expect in FY25 is essentially a function of acceleration in economic activity, and it is all the more driven by volume growth on the domestic market front, coupled with a recovery that we'll witness on the export front. So on exports, our expectation is as we head into the second half, we should probably see this lingering effect of the entire destocking bit, plus the excess supply from China starting to wade away. And to that extent, we expect recovery on the exports front to start in H2. Given what we are hearing from the managements and the outlook that is out there, it could be pushed more towards Q4 of FY24 as far as the export growth is concerned. In terms of the psychography, the portfolio essentially, like we were highlighting, is so we expect 25% EPS growth in FY24. The 25 number of 15% looks lower. That is essentially because of the fact that IOC is contributing to the base in 24 in EPS growth, while we expect normalization of profit in FY25. So that is one effect that will come off, and that is why you see a 15% number. A more normalized number would be closer to 20% as far as the earnings growth for FY25 is concerned. ROC continues to remain robust at 30%. We expect that to inch up primarily as a function of margin expansion happening due to better assets sweating as volumes pick up for a lot of the entities within the portfolio. In terms of performance, what we witnessed is we've seen some degree of catch-up in the last 6 months as far as the India Select portfolio is concerned as compared to the benchmark. The endeavor and the changes that we made, the endeavor of all those changes is that we continue to catch up on the performance in this particular year so that we can make up for the underperformance that we witnessed in the last year. In terms of changes, I think to a large extent, we have made a lot of changes in the portfolio. There are still certain pockets where we believe there is potential to add weight, something like auto ancillaries. Healthcare is another pocket where we believe there is an opportunity to add weight. So we continue to evaluate names there. And as and when we find as we narrow down on a particular name, I think that is one segment where we are essentially looking to increase exposure, and that is some changes that you'll witness as we go along in the next couple of quarters or so. Coming to the outlook, what has played out is monsoon. While it was very good in the month of July, it has been very erratic. If you look at the entire monsoon period of June till now, August has been significantly a dry weather patch and a dry spell that has, to a large extent, that is impacting agricultural activity on ground. So we are watching closely because the July rainfall has essentially provided a fair degree of moisture to the soil. But the dry spell is a tad bit worrying. So we are essentially monitoring that situation closely. Food inflation is a consequent impact of what we witnessed on the monsoon front, given the erratic nature of the monsoon that we witnessed. There is an uptick in food inflation, which is driving and putting upward pressure on the consumer price inflation itself. So that is one more number which is linked together with monsoons, which we are monitoring very closely, because a higher food inflation will essentially limit the elbow room for RBI to take any monetary action as we move along as well into FY25. In terms of volume growth, like we've been highlighting for some time, our expectation is that volume growth will pick up in the second half of this particular year. There are a couple of drivers that are there. One is the increased capex intensity, which puts money into the system. Second is the increase of 10% in MSPs, which should essentially support agri income despite acreages being under pressure, especially for paddy. Coupled with that, you have a year where there are 5 state elections followed by general election. So the expectation is there will be increased velocity of money within the economy. We are all monitoring the festive season very closely. I think last year had an impact of a very adverse festive season. That festive season was essentially impacted on 2 counts. One was the fact that there was volume pressure in the economy itself. Festive season wasn't great, plus the fact that it was preponed by a month. So that essentially meant that the window of spending on the festive season as compared to when the monies are in the hand of a large part of the rural side of the country, that window was squeezed last year. So that also had an impact on the festive season. The expectation this year around is, given that the festive season is a month later, you have a fair degree of window in terms of when the monies typically flow into the rural sector compared to when the festive season essentially kicks in. So the expectation is that volume growth starts to recover in the second half. This is a key monitorable as well as we look ahead, because if we again see a very subdued festive season, then that can have implication in terms of our earnings growth expectation. In terms of exports, like we've been highlighting, I think Q2 will still see some degree of pressure, primarily on account of destocking, primarily on account of increased supplies from China. The expectation is, and what we are incrementally hearing is that probably in second quarter is where you will see the reduced intensity as far as the Chinese pressure is concerned, and the fact that a lot of or a fair degree of destocking across a lot of user industries would have happened. Hence, as we look into H2 and particularly Q4 is where we believe you will get first uptick, primarily starting by normalization of the inventory. I think what is important to note here is the fact that there are a combination of things that have happened, which is leading to this entire destocking across a lot of industries. The first and foremost reason is the fact that we are seeing cooling off in global growth. We've actually seen a fair degree of cooling off in the growth and the growth expectation from China itself. So that is putting pressure as far as global demand is concerned. The second critical aspect is sitting in the COVID years, because of the fact that there were a lot of supply chain bottlenecks. What we essentially witnessed is that the inventory holding period across a lot of industries increased in the fear of the fact that you will not get inventories when you need them. So in a lot of industries, what we witnessed was inventory holding days in the channel went up from anywhere between 30-35 days to 60-65 days. So what we are witnessing right now is a combination of both these factors. While global growth will take its own time to recover, and that will happen as we look into more medium to longer term. What can happen in the very near immediate term is the fact that as inventories run down to their more pre-COVID normalized channel inventory levels, you will essentially start to see demand pick up. And from a more medium to long term perspective, what is essentially faring significantly well for the country as a whole is the fact that a lot of entities are very seriously now looking at moving their sourcing away from China. In a lot of businesses, because of the Ukraine-Russia war and the fact that how cost structures have behaved in the advanced world, what we are is incrementally hearing is not only China plus one, but there is an incremental shift away from manufacturing on fair degree of components from Europe and US to alternate sources, and that is where India also finds a fair degree of play and opportunity. Hence, the PLI scheme coupled with the tailwind on what is happening in terms of how global supply chains are looking to reposition themselves, positions us significantly well from a more medium to long term as far as exports is concerned. What we need to get over is this very near term hump, which is of inventory destocking and which is of some degree of accelerated pressure from China in terms of global markets. Having said that, structurally, like I was highlighting, both from an export and domestic point of view, we are well positioned for acceleration in growth. We need to just get through this near-term headwinds that have emerged, particularly on the export front, to some degree on the domestic front as well. So the expectation is as volume growth picks up in H2, we will essentially see a vicious circle of growth start to kick in, where domestic growth itself will fuel more money into the system, which in turn will start the process of acceleration in growth on the domestic front. And exports has a fair degree of tailwind that will kick in and will continue to provide a fillip from a more medium to long term perspective. The expectation is manufacturing share should eventually start to inch up as a percentage of GDP as we stretch out the time horizon. We are also from a services export point of view in a soft patch as far as IT exports are concerned. The expectation is as the global headwinds turn into tailwinds, you will also see that start to contribute as far as growth is concerned. So structurally, we are well positioned. As far as growth is concerned, we need to get over this near-term headwinds that are there. So I will pause here and we'll now open the forum for questions.
Right.
So over to you, Sanjay.
So thank you, Chetan bhai. Participants, I encourage you to please type in your questions. We will try to take most of them as we go along. So I'll start with one question that I have prepared for you is, so we've been hearing from the last call when we connected for ISP that margins have improved led by lowering of commodity prices and lowering of inflation, and destocking has also happened of inventory. So do you think that is we are at the peak of that cycle, that margin improvement from this effect will from here taper on and it will be more a function of volume, or do you think both things will play out together?
So Q2 will still see that impact playing out because Q2 as a base is still impacted. So you will essentially see fair degree of a YOY improvement in margin still sustaining. From a sequential point of view, the expectation is while a large part of the negative impact of margins has played out, so sequentially the quantum will reduce and sequentially the quantum will actually shift to volume growth. But from a year-on-year perspective, you still have a favorable base, not only for Q2, but also for Q3, assuming it's even a normal festive season. So last year was a severely depressed festive season. So even if we don't see a very high cheer festive season, and even if we see a very normal festive season also, that in turn means that on a base of last year, you will get a fair degree of support of volume growth. And because of volume growth, that also has some degree of play which happens because of operating leverage on margins. So our sense is by the time we exit this particular fiscal, we would have played out this lever. And then for FY25, it's more a story of volume growth that will play out.
Right. So thank you for that answer. Participants, do type in your questions. Chetan bhai, could you tell us a little bit about our exposure in BFSI? We have always historically been at least equal or overweight on BFSI, and as specifically with NBFCs and retail credit. Okay, so with our focus on retail credit, what is your sense there? How do you look at retail credit, the growth in retail credit and the asset quality there?
So if you look at from a more macro point of view, in terms of where household leverage is in the country itself, we are significantly lower as compared to the rest of the world in terms of leverage. So there is significant headroom that is available as far as structurally leverage in the system is concerned. Coupled with that, what we witnessed in the last 2 to 3 years is the fact that corporates also to a large degree have deleveraged their balance sheet. So that essentially means that to a fair degree, we've seen leverage in the system itself go down because of deleveraging that has happened on the corporate side, while retail credit has continued to grow. In terms of penetration, there is a lot of headroom still available for how retail credit itself can evolve going forward. Today, as a country, a large part of the credit exposure still is on the mortgage side, and even within that, there is some fair degree of under leverage that is there when you compare it to the more advanced economies of the world. So there is fair degree of room that is available itself for leverage. Our sense is as we continue to accelerate on growth, you will also see pickup in leverage. In terms of asset quality, I think since IL&FS, a lot of businesses have essentially witnessed a lot of headwinds as far as asset quality is concerned. So to a large degree, a lot of those learnings have been inbuilt into the models. So the memory of pain is very fresh, and I think that plays a fair degree of role in terms of underwriting quality itself in the near term. It's essentially in the boom period where this degree of history fades out, and you essentially start to see slippages that start to happen, particularly on the underwriting side. So our expectation is as we move along, you will get to a more normalized credit cost. Last year was a depressed credit cost, so you'll essentially move to a more normalized credit cost. There will be some degree of headwind that will happen primarily because, so on the bank side, you will essentially see some degree of headwind happen because cost of deposit started to inch up from November, while the lending rate itself will follow what is happening from the RBI side. So what we've seen a recent pause as far as monetary policy is concerned. So there will be some degree of squeeze that will happen on the NIMs itself as cost of deposits inch up. On the NBFC side, it will be the other way around. So you will essentially see a fair degree of tailwind that will happen as asset prices reprice because it's more a fixed price book. While as you start to witness some degree of softness on the rates, essentially NBFCs will actually witness NIM expansion as we move forward. So there, I think from it's less a function of how we believe credit quality will play out. It's more a function of how growth will play out as we move ahead. Structurally, there is fair degree of headroom that is still available as far as credit growth itself is concerned.
Right. So thank you for that, Chetan bhai. I'll ask Mr. Abhishek's question. So he's asked the rationale for being in defense stocks now. Okay, and also I'll just club it with PSUs. Okay, so collectively in the ISP portfolio, from not having any PSUs to having close to 6% in PSUs between IOCL, BEL, and State Bank. So what has anything changed in the way we perceive PSUs or defense sector per se?
So starting first with defense itself, so what we had witnessed was ever since this government came into place, there was a clear focus on indigenization as far as defense is concerned. While those policies were rolled out in 2018, 2019, we've historically seen that there has always been a fair degree of talk as far as indigenization is concerned. But in reality, we had not witnessed that play out. The trigger for essentially looking at this particular space was when we started to see the negative list that started to come up. That essentially throwed up a very clear opportunity. So a defense procurement annually is close to 2 lakh crore. These negative lists put together cover closer to something like 1 lakh crore. It is essentially when these lists started to come out, when we actually started to see tendering happen and order book wins starting to flow more to indigenous players, is when we felt that this time it appears to be more structural in nature. We have been very cautious because of our learnings in the past as far as the entire PSU pack is concerned. So we have been very cautious to pick and choose a name where we were more comfortable, both in terms of valuations, in terms of the visibility of the order book itself, and how we see order intake continuing. Because remember, these are more businesses which typically respond to how the order inflow happens. Executions are longer tail, and hence whatever order inflow happens today will be executed over a period of 2 to 3 years. So what is important is the order inflow also sustaining as the execution happens. So we've been very cautious, very careful while choosing a particular name on the defense side. So far, this is the only exposure that we have on the defense side. More structurally, I think there is a fair degree of play on the defense front, which is opening up on the private sector as well. There are participants which are present on the private sector, particularly on the defense side, across various components. Someone is active on the optical lenses side. You have an operator which is there on the radar side. You have subsidiaries of larger conglomerates, something like a Larsen, which is also active on the defense side. Bharat Forge is another name. So we are evaluating names very closely to see that how we want to play this particular opportunity. Another added trigger that will play out is the fact that as indigenization increases pace here and as these entities demonstrate their capability of localization and delivery to the Indian government, you will also see some degree of traction that will build up from the exports front. So exports can be an opportunity that will open up on the defense side. So we are being cognizant of that fact as well. And we are essentially evaluating that space from a more capability point of view and keeping cognizant to the fact that where valuations are as far as the sector is concerned and where we believe that visibility remains strong. And there is a significant degree of capability that these entities have while picking and choosing a name on the defense. On PSUs, like you clubbed that question, the fact is, sorry, we have been very cautious on PSUs given our experience historically on the PSU front. Again, here, as we have picked and added names into the portfolio, we've been cognizant of the fact that we've chosen names where we believe that structurally things have moved in the right direction. So if you look at SBI, what has structurally changed is the fact that we've actually seen share of retail increase over a period of time. The corporate book has gone down as compared to a share of their entire asset book. That means there is a fair degree of stability on ROA, which we can witness as we go forward. The bank has gone through a long period of transition since the entire PSU issue of asset quality happened. And they have executed really well. If you look at the way they've executed on YONO, which has been at the forefront as far as digitalization within banking system itself is concerned. So these are structural aspects that we've been cognizant about as we've chosen exposure in these names. Having said that, we still have a limited degree of exposure. We still continue to imbibe our past experiences. IOC is again a name where we believe that there are two things happening. Last year essentially was a year where you witnessed fair degree of headwind on the marketing margin side, as the government did not allow these entities to increase prices as crude prices were going up to keep a tab on inflation. What we expect more structurally is the fact that as we look globally into the refining space itself, what we are witnessing is that refining capacities itself are coming down. You are seeing some degree of shutdowns of refining capacity. That essentially means that refining margins can be more stable, medium to long term, as compared to how they have behaved historically. Coupled with that, you now have a very clear advantage of sourcing of Russian crude into India. That will still continue even as the war moves out, as Russia will need market for their crude. And very clearly, China and India are two large markets which are available for them. So to a fair degree, refining contribution can become more stable. Most of these government entities have also done fair degree of capex in the last 4 to 5 years. Most of these new refineries or even efficiencies within these existing refineries have gone up. That essentially means that the same plant can give you a better GRM as you move forward. And even if we build in a stable marketing margin environment, there is fair degree of cushion that is available on the valuation side. So that is where this exposure has found space into.
So thank you, Chetan Bhai. Participants, we encourage more questions. So what I understand is there's some kind of structural changes across the PSUs, the names that we have taken. Okay. From there, I'll move to my next question, which is about IT. Okay, so IT is one of our biggest exports to the world, and yet we have for a while been underweight on IT, with valuations kind of coming closer to mean or just becoming a little bit more attractive. What is your view on IT businesses, and would ASK at some point in time in the future look at some allocation to IT more than what it is now?
So, if you look at the entire space, IT itself, what we witnessed was during the COVID year, there was expectation that you will see acceleration in digitization and transformation. That essentially meant that there was a view that the growth rate itself would pick up as the transformation timelines would get squeezed to 5 years from 10 years. So that essentially meant that in a shorter period, you will see acceleration as far as growth itself is concerned. What has played out is also, so IT is a bellwether typically of how the global economy behaves, more so how US and the developed world behave. As soon as we've seen some degree of pressure there, what we've started to see is while structurally digitization remains in place, structurally transformation deals also continue to remain in place. Is the discretionary spend that gets cut off whenever you see headwinds. That in turn means that some degree of growth gets taken away. Coupled with this, we saw a fair degree of supply side pressure also play out in IT. That meant that margins also started to get squeezed as attrition went up and as there were supply side issues that played out. Currently, we are witnessing a reverse spectrum of that. So, our view, even at that point of time when things were not good and they still are not great for the sector, is that reality is somewhere in middle. You will essentially see a bounce back as far as top line dollar growth is concerned. Today, we are talking of very low single digit growth that can inch up to what they've historically delivered as far as constant currency dollar growth is concerned, which is mid single digit kind of growth, 7-8% kind of dollar growth. You are seeing margin pressures play out right now. Our sense is that both of these factors have never played out together. If demand is weak, eventually you start to see an adjustment that happens on the supply side. So you will get fair degree of margin tailwind that will play out as we look from a more longer period, or say another 3-year horizon. What we are witnessing right now is that we are still amidst the headwinds of global growth. We are still amidst the issue of challenges as far as discretionary spend itself is concerned. So there is fair degree of pressure on revenue growth itself. While valuations have obviously corrected before the earnings have corrected. So there is fair degree of cushion on valuations. From our investment process point of view, I think these are still businesses that can deliver closer to 10 to 12% earnings growth, which is a tad bit lower than what we typically look at for our businesses. This is more from a large cap IT space itself. There are opportunities on the mid cap IT side where there is structural tailwind given their size advantage. They can deliver growth which is upwards of 15%, which is what we look at for our schemes and our strategies. We continue to evaluate these names. And at an opportune time, if we find an opportunity, we will essentially go ahead and add names there. So right now, historically, also we've remained underweight. It's more of a function of how we see growth play out, while asset quality continues to remain significantly well in that particular space.
Right. Thank you, Chetan Bhai, for the detailed answer on IT. We've got a question from Mr. Suresh Srinivasan. So it is more on the performance. Okay, but I'm not going to be asking you when we will see our performance vis-a-vis the benchmark. What I'll probably request you to talk about is what has happened with the performance, because we've seen a very good top line and a bottom line. I mean, maybe not top line, but good, healthy bottom line growth. Also, as an investor, you get anxious at these times when the market might tend to be better than your portfolio. What is your advice to investors then? How should they look at it? And just in general, your thoughts on performance.
So I think last year what we witnessed was, while we saw strong operating profit growth for the portfolio as a whole, we essentially saw the portfolio correct. That has two implications, and there were so the reason for that to happen was one was we also saw a very sharp increase in global cost of capital. That essentially meant that anyone who is in our style of investment, which is high quality, high growth, there is some degree of derating that happens if there is such a sharp increase in cost of capital. The second aspect that essentially plays out is typically there is, while from a more medium to long term perspective, portfolio performance or performance of a particular stock is very closely linked to how the earnings behave. In a very short run window, there can be lead and lag that plays out. So last year was probably a year where earnings growth happened, but we witnessed some degree of correction on the portfolio. That also means that relatively these portfolios have become more attractive as far as valuations are concerned. So we actually saw contraction in PE. In the first sign of growth picking up, we've actually seen outperformance start. Uh, Given that we are on the high growth side of things, whenever there is clarity or visibility of growth improving, you will typically see stocks starting to outperform, because the biggest risk in our style of investment is growth itself. And the biggest tailwind for our style of investment is also growth. Our expectation is that as we look at earnings growth for the portfolio, we still continue to see higher earnings growth compared to the benchmark that can get delivered in 24. Similar picture is visible for FY25 as well. So our sense is this lead lag will play out as we move ahead. Very difficult to say, like Sankalpur, you rightly highlighted, when this will happen. But as far as our companies are not losing market share, if the growth rate itself is not going down for our companies, they continue to deliver on superior growth in line with what we expect. Our expectation is performance will catch up. You will also see some degree of tailwind that will play out as global cost of capital starts to ease, while we don't counter or don't factor that in. When we look at the portfolio and expect performance from the portfolio, that is an added that will play out. That was a factor which detrimentally impacted us last year. Very difficult to say when that will happen, but clearly from a more fundamental point of view, given the earnings delivery that the portfolio is witnessing and is expected to deliver, our sense is you will see catch up that continues to happen. We've seen some glimpse of that. The expectation is that will play out. In the meantime, there are certain lessons that we've also learned in this process. Because of that, we've started to evaluate certain names and pockets where we believe that while medium to long term things would be very attractive, if there are certain headwinds in the very near term, we are being cognizant, we are being more agile to make those necessary changes to the portfolio. There are certain pockets still where we believe weights can go up, and we continue to evaluate those pockets to continue to strengthen the portfolio.
Right, right. Thank you. And to the listeners, like Chetan was saying, catch up has started to happen. In the last 6 months, we are up by around 18% in the ISP India Select portfolio versus the benchmark's 14.5%. Moving on, we've got a few questions, Chetan, and I'll let them. I'll tell them to you. So from Vivek Prakash, we have a question on chemical sector. Okay, so do you think the tide will turn around, and what are your general thoughts on the chemical sector?
So what we are witnessing right now, and thank you for that question, what we are essentially witnessing right now is the fact that, like I was highlighting, there is near-term pressure because of confluence of two events. One is the entire destocking that is going on. Second is the fact that higher inventories from China are getting cleared off. If you were to just zoom out from this picture and look at the space more structurally from a medium to long-term perspective, India still has a very minuscule share as far as the global chemical space itself is concerned. We are today close to 220 billion as far as the chemical industry size is concerned. There is a fair degree of tailwind that is available as companies look to move supply chains away from China. We are continuing to see managements go ahead with their capex plans. They continue to witness fair degree of inquiries. We've actually seen a lot more long-term contracts getting signed across the board and across the space. So structurally, things remain pretty much intact. What we essentially need to maneuver is this very near term. Our expectation is the sector itself is clearly geared to deliver 10 to 12% growth from a more 5 to 10-year perspective. That will mean that 200 billion industry size today can essentially become 500, 600 billion over a more longer term period. All the structural factors are in place. We are actually seeing inquiries, contracts, tendering continue to remain strong there. So directionally, we are in the right direction. If the industry growth is 10 to 12%, anyone who is able to garner this growth better and more effectively and efficiently can actually end up delivering upwards of 15 to 20% growth for a sustained period of time. As the country moves ahead, and the key strength of India in the chemical space itself has always been more on the value added side, because the commodity side was predominantly taken over by China. As we move ahead, the issue that the space itself will have to solve is more of key sourcing material. And that is one pocket where we are increasingly seeing most of these companies even talk about backward integration. That gives them a better degree of control on the entire chain itself, and that is required from even from a customer point of view to have the confidence on they are actually truly being able to delineate themselves from the risk of China. So what we will witness as we move ahead is you will not only see revenue-driven capexes, you will also see capexes where companies will look to strengthen their supply chain and increase or improve backward integration of their entire supply chain, which in turn will provide them fair degree of control and independence as this sector itself scales up. So we will have to deal with some degree of headwind. We've seen a fair degree of that impact play out in Q1. What we are picking up when we interact with managements is Q2 will also see that impact playing out. Their own expectation is that Q3 is where you start to see this effect starting to wane off a bit before we start to again get back to the growth journey that we were witnessing in the last 2 years.
Thank you, Chetan bhai. I hope, Mr. Prakash, that answers your question. We've got a question from Mr. Abhishek again, and it's the elephant in the room that a lot of people have been discussing between Jio Financial and Bajaj Finserv, one of our larger holdings. So last time Jio's took a market by storm was when it came out with telecom, and then it was a long pricing struggle that took place. So what are your views? I know it's too early to comment anything on Jio's line of business, but what are your preliminary thoughts?
I think we'll have to, like you rightly mentioned, we'll have to wait and see what is their go-to-market strategy on the financials bit. I think this is a space where a lot of players have come, particularly not only domestic players, we've also seen fair degree of MNCs also participate in this particular space. What is very crucial in the finance business, particularly on the lending business, is the fact that how strong is your collection department. So to scale up or disburse money is not a bigger challenge as far as financials are concerned. It's your underwriting capability to get the monies back from the customer while balancing growth and ROE. So we'll have to essentially see what is their go-to-market strategy, what are the segments which they are focusing on. If one were to just do a quick outside in perspective kind of a check, then probably for them they would be looking at the captive customer base of Reliance Jio itself to target to begin with. They will have fair degree of data on those customers, so that is one pocket which they can essentially start to explore, but still very early days. We'll essentially have to see what their game plan is. What we've seen as in the sector itself in the last few years is we've actually seen fair degree of periods of increased competitive intensity. We've also seen periods of severe underwriting issues which have impacted the space, particularly post IL&FS. And like I mentioned when you initially asked me, I think the room to grow is significantly larger. So you are under leveraged economy from a household perspective. It's an under leveraged economy as far as SMEs, MSMEs are concerned. So there is a fair degree of headroom for anyone to grow. So our sense is as the economy matures, as the economy accelerates, the requirement itself of credit will go up. That will open up the space as well. You still have fair degree of headroom of penetration also to play out. So our sense.
Chetan bhai, I think we lost you. Your video is frozen.
I'll just check, Sankalpo.
From a more long-term perspective, in terms of balancing ROEs, balancing asset quality. The businesses that
we lost you in between. Can you just repeat the last part again?
Yeah. So I'm saying we'll have to essentially see how competitive intensity plays out. Our expectation is the space itself is significantly large. There is a lot more room available for players to come into the space as well. We've seen the names that we own have gone through a lot of cycle of adverse period, be it demon, IL&FS, COVID. So those business models have been tested already by the events that have played out. So we are keeping a close eye to see how it plays out. But we aren't very too worried as well because we believe there is headroom for everyone to grow in this space. So we'll keep a very close eye on how things play out as they essentially go ahead and launch.
Right. So if I hear you correct, the industry can accommodate a Bajaj Finserv and a Jio. So that's the thought there. So the next question that I'm going to ask you is about consumption, and most so if we're expecting a volume recovery this festive season. But what we've observed in the last few quarters is that the product mix for high margin, or let's say luxury or discretionary products, has been adverse. Okay, so they're selling more lower margin and lower value products across the board. So do you think that kind of consumption will revive in this festive season, or we still have some time where higher margin products come back in the mix in a big way?
So I think, Sankalp, what has played out in the very near term is the inverse. So what has happened is we've actually seen high ticket items do well in terms of volume growth. So if you see SUVs, they've done well. If you see iPhones, and that bracket of consumption has done well. 40-inch plus TVs, they've done well. Where the challenge really has been on entry level across the board, be it two-wheelers, four-wheelers, consumer discretionary. So that is where the challenge has been. This challenge is essentially coming from the fact that we've actually not seen rural balance sheets recover ever since the Delta variant. That is where savings got significantly impacted. We've not seen a very good monsoon patch ever since then, which has provided the ability for rural balance sheets to repair. And that is what is leading to an overall sluggishness as far as consumption is concerned. Uh, as we look at a very near-term picture, I think our sense is if you see incomes there improving, which is our expectation, you will actually see pent-up demand playing out in the entry-level side. So you will actually see a fair degree of pent-up demand that will play out on entry-level two-wheelers, four-wheelers, mobile phones, consumer durables, because that is where pent-up demand is sitting at this point of time. Structurally, as the economy evolves and grows and as per capita income grows, our sense is you will actually see discretionary start to do much better because in terms of penetration, staples are fairly penetrated. So it will essentially be that even within staples, premiumization will play a larger role as the economy accelerates. Between staples and discretionary, our sense is discretionary is where the acceleration will be faster compared to staples as a pack itself. So that is how we are looking at consumption from a more medium to long-term perspective. From a very near-term perspective, we expect pent-up to play out as things or as volume recovers towards festive.
Right. Thank you. So, good, you mentioned autos and SUVs and two-wheelers. There we've got a question also. That is one area we are underweight largely. So, what are your thoughts on the auto businesses and specifically OEMs? Over to you.
Yeah. So we have one exposure in autos today that is more on the electric vehicle auto hang side. Like I've been highlighting, we are looking at names which can be populated in the portfolio as far as autos are concerned. From an auto OEM point of view, purely, I think what we are witnessing is a function of, like I was highlighting, a near term and a longer term. While near term, there can be a tailwind of entry level doing well, which supports a lot of growth for the likes of Maruti or the portfolio of Hero or even for Bajaj and TVS. From a more medium to long term perspective, we are in a situation where there is an energy transition that is happening in that particular space itself. Fairly difficult to say who ends up at what kind of market share from a more medium to long term perspective. So we've always been more focused towards the more on the auto ancillary side, where we believe that you can play both these themes. We are essentially looking at names which have the capability to deal with this transition from a more medium to long term perspective as well. And that is how we are looking to play that pocket. On the four-wheeler side, clearly you have three listed names, Tata Motors, Mahindra and Mahindra, and Maruti. What we witnessed is because of the fact that the segment of Maruti, which is the entry level, has been suffering, we've actually seen fair degree of market share loss on Maruti because SUVs is a pack which has done well, or a higher premium end product that has done well. Maruti has slew of launches as we look at Maruti from here on. But even there, from a more medium-term perspective, it is how each of these entities are approaching energy transition. You will see fair degree of competition also increase on the electric side. While today we see a lot of Tata Motor vehicles on road, they are the leaders as far as market share is concerned on the electric side. Given their success, our expectation and our sense and the feedback that we are getting is it is attracting a large number of more players on the electric side. So again, OEM will probably be a pocket where difficult to point out who will end up with what kind of market share. So we are still sticking to some degree with the auto anch players itself. We are evaluating, that is a pocket where we see some degree of underweight in our portfolio. So as and when we narrow down on a particular name, you will essentially see that get populated.
Right, right. Thank you, Chetan bhai. So as we are coming to the close, just couple more questions. One is from Mr. Dave, Nishit Dave. So he's asking about railway sector, but let me just club it with logistics as a overall broader theme, because we've been hearing a lot to happen there in India, last mile connectivity. So what are your thoughts on railway as an railway related stocks and the logistics business as a whole? Thank you.
So clearly, I think biggest bottleneck for making India a manufacturing hub is logistics cost. So while globally the benchmark logistic cost is closer to 8% of GDP, we are today at anywhere between 12 to 13% of GDP. So there is a clear headroom available for logistics cost to go down and improve competitiveness for the country as a whole. And that in turn will provide a fair degree of foundation also for acceleration of manufacturing and manufacturing out of India for exports as well. Railways is a critical component of that ecosystem. We are seeing fair degree of modernization that is happening on the railway side. We are essentially seeing modernization happen both on the tracks, railway station infrastructure, also the entire DFC. While it is delayed, our expectation is by next year you will essentially start to see DFC getting operationalized. And railways itself or DFC itself will play a significant role in reducing the logistics cost as well in a more efficient manner. Having said that, when we look at that pocket itself, it is to a large extent dominated by either PSUs or when we look at capital goods suppliers, it is a fair degree of exposure of MNCs that sits there on that particular side. While we believe growth is accelerating there, what we are keeping a close eye and where we are evaluating these names is also the fact that we would typically, so given our experience with PSUs, we will typically prefer names which are more capital good of suppliers to this particular pocket, as opposed to being operators in that particular space. There is opportunity on the logistics side, which is available more even on the ports front, on the express front, which is more delivery and cargo. So we are looking at names there. We have most of those names under our radar. At an opportune time, if we find that those prices and valuations are supportive, we will probably go ahead and populate. So very clearly, that is a large opportunity that will play out. That is an opportunity which is required to play out to make India more competitive. There is a clear focus from the government as far as that space is concerned. There are names which obviously are there, a part of our universe, but at an opportune time, we'll probably take a call on where we want.
Right. Thank you, Chetan bhai, for that detailed answer. Last question for today's session, unless we get something more here. So at ASK, we've always been high quality, and high growth. So is what we have always bought into. So can you just tell us how that experience has helped us through market cycles and through difficult and good ones, sticking to high quality and high growth? And with that, we'll probably end today's call.
So I think markets will have, so there are various ways to play the market itself, and there is no one correct way or one right way or a wrong way. Every or different methods have the different merits, different methods have the different pro and cons. What we have believed and the study that we had undertaken, and an outcome of that study was IEP. So IEP was an outcome of that study that we undertook. What we witnessed was in that study when we were analyzing top 1,000 companies as a part of that study was various factors and attributes that contribute towards wealth creation from a more longer term perspective. What we witnessed was that there were two very critical and crucial aspects. One was growth itself, which essentially helped compound wealth over a longer period of time. Second was capital efficiency. So growth and quality of growth, both were equally important to generate wealth over a more longer term period. While shorter run, you will obviously witness cycles where the market favors one particular style compared to the other style. our experience has been, and the analysis that we've done, that essentially suggests that if you have a combination of good quality growth and high growth itself from a more medium to long term perspective, that should ideally lead to compounding of wealth over a period of time. So we are probably in a pocket or space where we essentially look to generate returns more from compounding. There is an other way to essentially generate return, which is more of catch up in terms of gap between undervalued and fairly valued stocks. If we find a name where we believe that there is a fair degree of safety as well available, that essentially adds to compounding itself. But as an attribute, we are typically more on that part of the market which looks to generate wealth from compounding. And we've seen that from a more medium to long term perspective has delivered in superior experience as far as wealth creation itself is concerned. While in the near term, you will see these patches and pockets that play out as market favors one particular style compared to the other.
Thank you, Chetan bhai. Thank you to the participants for logging in today. If you have any questions further, please do feel free to write to your respective RMs, and we will try to take most of them. Do follow us on our social media handles, LinkedIn and YouTube, for any more such videos that we do every quarter. Thank you, Chetan bhai. Happy investing all. Thank you. Good evening.
Thank you so much. Thank you everyone for joining.